One of America's most important strategic allies in the Middle East just walked out of the organization that has been setting global oil prices since 1960. After 60 years of membership, the UAE announced its departure from OPEC. And almost simultaneously, the UAE's central bank made a statement that should have generated front-page coverage in every financial publication on the planet, that it might begin pricing its oil sales in currencies other than the US dollar. This was reported by Reuters, by the Financial Times, by Fortune. This is not a fringe interpretation or a speculative claim. It is documented, confirmed, and publicly stated. And yet the majority of investors I speak with have either not heard about it or have not understood what it means for the monetary system that has underpinned American economic dominance for 50 years. I want to explain exactly what is happening, but not the geopolitical drama version, but the precise mechanical version that tells you how capital flows will respond and where the structural opportunity sits. Because gold is not rising because of fear. Gold is rising because it understands something that most equity investors have not yet processed. Let me start at the foundation, because without understanding the petrodollar system, what it actually is, how it was constructed, and what has kept it intact for half a century, the current developments are impossible to evaluate properly. In 1974, following the oil shock that produced gasoline lines around city blocks and inflation that threatened to destabilize the American economy, Henry Kissinger flew to Saudi Arabia. What he negotiated was not a formal treaty with defined terms and an expiration date. It was a set of informal arrangements, a handshake deal in effect, that restructured the relationship between American power and global energy markets in a way that has shaped every aspect of international finance since. The arrangement had three pillars. First, oil would be priced and sold globally in US dollars. Every country on Earth that needs oil, which is every country on Earth, must first acquire dollars to purchase it. This creates a structural, permanent demand for the dollar that is entirely independent of the attractiveness of American financial assets or the credibility of American monetary policy. The demand exists because energy exists, and energy requires dollars. Second, the petrodollar revenues that Saudi Arabia and the other Gulf oil producers accumulated would be recycled into U.S. financial markets, specifically into U.S. Treasury bonds. The dollars earned from oil sales would flow back to Washington as loans to the American government, keeping U.S. borrowing costs artificially low and creating a permanent backstop for American deficit spending. The U.S. could run fiscal deficits that no other country could sustain because there was always a large structural buyer standing ready to finance them. Third, in exchange for these arrangements, the United States provided the Gulf monarchies with military protection, weapons systems, political support, and the guarantee of American security presence in the region. A mutual arrangement. You price oil in our currency and buy our debt. We protect your governments and your oil fields. This machine, invisible to most investors, operating continuously in the background of every financial transaction on the planet, is the single most important structural reason why the dollar became and has remained the world's reserve currency. It is the source of what economists call the exorbitant privilege, the ability of the United States to import goods more cheaply than any other nation, to borrow at lower rates than its fiscal position would otherwise justify, and to run persistent current account deficits without the currency crisis that would destroy any other country attempting the same. The petrodollar is not background noise. It is the engine of American financial dominance. And right now, three specific fractures are appearing in that engine simultaneously. This is where the situation changes. The first fracture is the UAE's departure from OPEC. To understand why this matters beyond the headline, you need to understand the UAE's specific position within the organization. The UAE has invested enormously in expanding its oil production capacity, building infrastructure capable of producing 5 million barrels per day. OPEC's quota system limited it to approximately 3 to 3.5 million barrels. For years, the UAE has been operating a factory at 60% capacity because its business partners told it to. The economics of that arrangement became increasingly untenable as the UAE's investment in production capacity grew. But the departure is not only about production quotas. The UAE joined the BRICS alliance in 2024, the bloc of nations that has been explicitly constructing alternative trade and payment systems designed to reduce dependence on the dollar. And the UAE's central bank statement that it might be forced to shift oil sales to the Chinese renminbi is not hypothetical speculation. China is the UAE's single largest oil customer. The commercial logic of pricing oil sales in the currency of your largest buyer is straightforward. The geopolitical logic of reducing dollar dependency in a period of regional instability is equally straightforward. The two logics are converging. The second fracture is broader than any single country's decision. Saudi Arabia, the anchor of the entire petrodollar arrangement, the country whose cooperation with Kissinger in 1974 created the system, is in active negotiations with China for long-term oil supply contracts that could be priced in renminbi. These are not preliminary discussions. They are structured negotiations for 10 to 20-year agreements. If they conclude successfully, the foundational pillar of the petrodollar, that oil is priced and settled in dollars, will have been materially compromised at the source. India completed its first rupee-denominated payment for UAE oil earlier this year. Russia, having been effectively expelled from the dollar system through sanctions, has been trading energy with China, India, and other willing partners in local currencies for over 2 years. The pattern across these developments is not coincidental. It is the cumulative result of individual countries making rational decisions about their own currency exposure in a world where the weaponization of the dollar, the freezing of Russian central bank reserves in 2022, demonstrated that dollar-denominated assets are subject to political discretion. The third fracture concerns the second pillar of the petrodollar, the recycling of oil revenues into US Treasury bonds. China's holdings of US Treasury bonds have fallen by approximately 50% from their peak. This is not a small adjustment. China was once the largest foreign holder of US government debt. Its deliberate, sustained reduction of that exposure represents a fundamental shift in the demand base for American borrowing. Some other countries, Japan, the United Kingdom, have partially offset this reduction with increased purchases, but the directional signal from the world's largest trading nation is unambiguous. The recycling mechanism that kept US borrowing costs artificially low is weakening. And here is what connects all three fractures to gold. Because this is the part most analysis gets wrong. The countries reducing their dollar exposure are not moving into euros or yen or renminbi. Those are simply other fiat currencies with their own dependencies and vulnerabilities. The asset they are moving into, in quantities that have not been seen in modern history, is gold. Central banks globally purchased over 1,000 tons of gold last year. Poland, Kazakhstan, India, China, Brazil, Uzbekistan, countries across vastly different political systems and economic models, arriving at the same allocation decision for the same structural reason. After the US and its allies froze $300 billion of Russian central bank reserves in February 2022, every treasury ministry and central bank on the planet conducted the same risk assessment. The question was not whether Russia's actions justified the response. The question was, if our reserves are held in a system controlled by a potential adversary, are those reserves actually ours? The answer, demonstrated with perfect clarity by the Russian episode, is conditionally. Your dollar reserves are yours as long as your government's relationship with Washington remains acceptable. The moment that relationship deteriorates, the reserves can be frozen with a digital instruction to a correspondent bank. Gold held physically in domestic vaults answers that question differently. It cannot be frozen by a foreign government's executive order. It cannot be sanctioned. It cannot be made to disappear by a regulatory instruction. It has no nationality. It has no counterparty. And it has functioned as a store of value for 5,000 years across every monetary system that human civilization has constructed and then discarded. The central bank accumulation I described is not a sentiment-driven trade. It is a rational, long-horizon institutional decision by the organizations with the most comprehensive understanding of monetary system risk. The people who manage national reserves, who have seen currencies fail, who have studied the history of reserve currency transitions. When they move from dollar-denominated assets to physical gold at a pace that has not been seen since the immediate post-Bretton Woods period, They are expressing a view about the long-term trajectory of the current system. That view deserves serious analytical attention. Now, I want to address something that I think most retail investors are getting fundamentally wrong about gold's recent price behavior. Because the confusion about why gold moved the way it did, rising sharply before the conflict, falling during the acute phase, and then recovering, reveals a misunderstanding of what gold actually responds to. Gold does not primarily respond to fear. This is one of the most widely repeated and least accurate statements in financial commentary. Gold responds to real yields, to dollar direction, and to liquidity conditions. During the acute phase of any geopolitical crisis, several forces temporarily suppress gold even as the apparent fear environment suggests it should rise. The dollar strengthens as global capital seeks the most liquid safe haven. Real yields rise as the Fed is frozen from cutting rates by inflation concerns. And leveraged investors who hold gold futures and leveraged ETF positions face margin calls, forcing liquidation of exactly the asset that looks most attractive on a fundamental basis. This mechanical suppression, which I have analyzed in detail in previous videos, is temporary by definition. It ends when the leverage clears. And when it ends, gold reverts to reflecting the structural forces driving long-term demand. The de-dollarization I have described, the fiscal debasement of fiat currencies, and the physical supply constraints of a commodity that requires years to bring new production online. The three structural forces supporting gold are worth naming precisely, because understanding them is the foundation of any coherent positioning decision. The first is de-dollarization, the systematic reduction of global dependence on the dollar as the primary reserve and trade settlement currency. I have walked through the evidence: UAE leaving OPEC, Saudi renminbi negotiations, India's rupee oil payment, China's treasury holdings reduction, central bank gold accumulation. These are not isolated events. They are manifestations of the same underlying shift, a gradual structural movement away from the dollar-centric system that was constructed in 1944 and modified in 1974. The pace of that movement is slow. Its direction is not in question. The second is debasement, the continuous erosion of fiat currency purchasing power through monetary expansion. The United States has added approximately $2 trillion to its national debt in the past year alone. The interest payments on that debt now rival the defense budget as a line item in the federal budget. The resolution of this arithmetic, the only politically viable resolution, involves some combination of inflation and monetary accommodation that gradually reduces the real value of the debt. Gold cannot be debased. Its supply grows by approximately 1 to 2% annually through mining, with no possibility of acceleration through policy decision. In an environment where the dominant reserve currency is being debased through fiscal necessity, gold's scarcity is not a historical curiosity. It is a structural advantage. The third is diversification, the rational portfolio management response to a world of geopolitical fragmentation. European nations are rearming, Asian supply chains are restructuring, trade relationships that were stable for decades are being renegotiated under geopolitical pressure. In this environment, concentration in any single currency or any single geopolitical bloc carries risks that did not exist in the same form a decade ago. Gold provides diversification that is genuinely independent of the political relationships and financial system architecture that determine the value of every other reserve asset. Now let me address where this leaves the specific investment opportunity, because I want to be as precise about the practical dimension as I have been about the structural one. Gold bullion, physical gold, or unleveraged ETF exposure is the foundational position for investors who want direct exposure to the de-dollarization, debasement, and diversification thesis. It does not generate cash flow. It does not compound, but it maintains real purchasing power across monetary system transitions in a way that no fiat currency has historically been able to match. The Roman centurion's ounce of gold bought a quality outfit 2,000 years ago. It buys a quality outfit today. The dollar that was worth 100 cents in 1971 is worth approximately 7 cents in 1971 purchasing power terms. The comparison speaks for itself. Gold mining companies provide leveraged exposure to the same thesis with a different risk profile. A miner's revenue is determined by the gold price. Its costs, labor, energy, equipment, are largely fixed in the near term. When gold rises 25%, a miner's operating profit can increase 30 to 40%, depending on its specific cost structure. This operating leverage is the reason miners historically outperform bullion during sustained gold bull markets. The current environment, where gold's structural tailwinds are as strong as they have been at any point since the 1970s, is precisely the environment where that leverage is most valuable. The specific names I am monitoring are approaching technical levels that, based on the volume patterns and institutional positioning data, suggest the accumulation phase is reaching completion. But I want to close with a broader observation that I think is the most important thing I can offer you from this analysis. The petrodollar system did not fail overnight. It did not fail with a single dramatic event. The 1971 Nixon shock, which ended the dollar's gold convertibility and initiated the modern fiat era, was the culmination of pressures that had been building for years. France had been demanding gold redemption for its dollars since the mid-1960s. The gold outflows from the Federal Reserve had been accelerating. The fiscal pressures of Vietnam and the Great Society programs had been mounting. The shock was sudden. The conditions that produced it were not. The current fractures I have described, the UAE's OPEC departure, Saudi renminbi negotiations, China's treasury reductions, central bank gold accumulation, are the accumulating pressures. The shock that crystallizes them into a visible, undeniable systemic transition may not occur this year. It may not occur in the next several years. But the direction of the structural forces is not ambiguous, and the pace of accumulation is accelerating in ways that the data I have cited makes objectively measurable. The investors who positioned for the post-Bretton Woods monetary transition in the early 1970s, who held gold at $35 per ounce and maintained that position through the volatility and criticism that accompanied it, captured a move to $850 over the following decade. They were not rewarded for being dramatic or alarmist. They were rewarded for understanding the structural forces before those forces became obvious in prices. The petrodollar is not dead. The dollar is not going to zero. The US financial system, despite its fiscal trajectory, remains the deepest and most liquid in the world. But the unchallenged monopoly, the system in which every barrel of oil requires $1, in which every oil producer recycles revenues into treasury bonds, in which the exorbitant privilege operates without constraint, that system is fracturing. The fractures are visible. The capital flows that are responding to them are measurable. And gold, which has always been the monetary asset that reflects the real cost of maintaining paper currency systems, is telling you something specific about what it sees. The question is whether you are listening before the translation becomes obvious to everyone else.